Hi, welcome to Money Confidence. I'm Crystal Oculee, and I'm the Chief Financial Strategist here at Confidence Wealth. Every week, I try to bring a topic to you that's important and timely and what everyone's talking about. And you have seen the last couple of weeks, the conversation has been all around the market volatility. So I'd like to talk a little bit about that. One of the things that you hear a lot of us talk about that we just sent out existing clients, you probably got our roundtable that just recently came as well. We really discuss why a foundation of a plan is so important because throughout history, as you know, markets will go up, markets will go down. And what's always very interesting to me is that's when a lot of people think, when market is volatile, let me get out, stay on the sideline, and then hop back in. And that's the problem. Hop back in when? Usually it's after the big, pickup, after the market goes down. The pickup happens, and most people really miss that right up. It's really about having the right buckets, the right strategies, and the foundation to help you through the waves that will occur, not have you go on the side and wait and hope to get back in at the right time. What do we learn when volatility happens is that it is part of just the game that you have to play for the long term. And I know it sounds silly when you think about, oh, it's a game. Well, that's the market, right? That is what it's going to constantly do. The ups and downs. Think about it. Someone had figured out how to avoid all of the losses of the market and be able to get back in at the right time. Well, they would have that magic secret with them, and they would never share it with anyone. So in a sense, if you stayed on the sideline or you only stayed in cash, you will miss out growth and your money will not really keep up with the value of inflation. So it is really important to stay strong during these times as long as you have the right foundation in place. Again, our current holistic clients, I'm not concerned about because we've already run all these numbers for you. You ran a stress test. You know that you have different buckets that are set up for different times. And that is the key because it is set up with the right foundation in place. For people that don't have that yet, so whether you are at the transition stage right now of onboarding, or you are, example, a friend of one of our clients or a colleague, and you're listening to this and you're thinking, you know what, Crystal, what buckets? And I don't know. And if you don't have a discipline in place and you don't know what that means, that's when having a stress test and getting a second opinion right now is really important. And we'll be happy to do that for you. But if you have the right foundation in place, and we've already gone through this with you, this is the reason why you really can be comfortable through this process. I'm going to share a screen with you really quickly and remind you of the ups and downs of the market and really what occurs and the things you need to really watch out for. So give me a moment to really quickly. Here we go. So if we look at historical performances, right? If you look through here, there's always these ups and downs of the market, right? You've seen me talk about this. You've seen me talk about this on our webinars. And what is really important is that during these periods of times, if someone is retired and they're taking money out, and if they have their entire portfolio, example, in an aggressive S&P 500 type of a style of a plan, not really having a solid strategy in place that has different buckets dedicated for different times, then it's really a heads we win, tails we lose game. Because if you're here and you had retired, for example, and you were taking money out while the market was going down, and this was affecting your entire portfolio and you didn't have a protected side, then what would occur is that you're taking money out while the market is going down. And you can see it took a good from 2000 to 2012 is how long it took for it to be just flat at that point. So imagine if you had $1 million and you didn't touch it, by 2012, you were back at $1 million. You lost value of time. But imagine now you were taking money out. And that's when, if you recall, in a lot of our education, I talk about the two brothers. So here's an example. So imagine Steve had retired in 1990 and the sequence of return, meaning the positives were happening at the beginning years of his retirement. And if he was in an aggressive strategy, then if he had $500,000 and he took out 30,000 per year, by the end of 10 years, he still had 1.2. It worked in his favor because the beginning years were really in positives and he really didn't have that big impact. But his brother, who retired in 2000 in this example, and he was taking 30,000 out of his $500,000 portfolio, by the end of 10 years, he only had 156,000 left, because for him, he retired during this period of time. And that is what really backfired on him. And he had to hold, in this example, he had his entire portfolio in these types of strategies where it's, moderately aggressive and it can go either way. But that's the whole purpose of having a foundation in place, because when you have a good foundation in place and you have the protected side, then the part that's in the market will have its time to recover because you have that fallback to go on. And that's the entire purpose of having right buckets for different times, where you have, let me stop sharing this, where you have a bucket really structured for protection. You have a bucket that's for short term, a bucket that's for medium term, like, maybe 5, maybe 7 years down the line. And then you have a bucket that's more for the future, 10 plus years. So those are the buckets you can be more aggressive with. But when you have these right strategies in place, the last thing you want to do is get in and out, because then you're going to really miss the actual upside and really have an issue. And that's what you don't want to have happen. I'm going to share another quick little screen with you because I thought this was a great one, where you look at, I just want you to see the ups and downs of the market in here. So this is actually the blue. So if you look at the blue, that is the S&P 500 going up and down from year 2013 until just very recently. So you can see that, we had a lot of down. We drew this line. I drew this line for you just to see that if you just had to go steady, and then everything was okay. It still was on the upside. The problem was during these downsides right here, or even now when it goes down, if you are dipping into your money and you don't have any other buckets and everything is at this risk and it goes here, then recovery will be just too much and it may never occur. But when you have part of your portfolio in something like this, and then you have the rest in different strategies, then you can see if you just leave it alone, you're going to be okay. And that is the big issue at hand. So you really want to make sure that you're set up in a way that, again, the foundation is in place. It's customized to your situation. And that's why you get to sleep at night. So clients, that's why I want you to sleep at night, because as holistic clients, we've gone over this with you, right? You've got all these different buckets that are set up for different times. And that is exactly the reason why you can sleep at night. Now, if you're sharing this and you want to teach someone in your life what I just showed you in this last few slides, this is where you really want to encourage those people around you that don't have a foundation in place. And they're really afraid because everything is at the mercy of a moderately aggressive portfolio at the market. You're absolutely right. This could really backfire on them. And this could really lead them to not have the comfortable retirement they expected. In some cases, a devastating retirement. And that's why right now getting second opinions is really important for those who do not have a good foundation in place. But for those of you who do have this foundation in place, you already have your team here with Confidence Wealth. You already met with your team. You tested against all these. I want you to sleep at night and don't let the ups and downs, temporary situation really affect, your emotional judgment of getting in and out at the wrong time. It's those of you who don't have a foundation that I'm concerned with. So with that said, if you have any questions for me, don't hesitate to reach out. Current clients, if you want to meet with your team and just feel more comfortable and rerun the stress test, feel free to do so. Reach out to us. And for those of you who are friends and family of our clients, this is the time to get a second opinion. Hope this has helped you. If you need any other thing you want me to address and talk about, please feel free to reach out to me. Otherwise, I'll see you next week for another round of Money Confidence. Talk to you soon.